Let's be honest, just hearing the words tax audit can make your heart skip a beat. It makes you start questioning everything, right? But what if we could swap out that anxiety for some actual facts? In this explainer, we're going to break down your real, actual odds of getting that dreaded letter in the mail.
You should think of your tax return like a story. It's your financial story for the year, and every single number on there is a part of that narrative. So if one of those numbers looks out of place or just raises a question, you can bet that your story is about to get a much, much closer read.
So, with all that potential scrutiny, what are we really talking about here? What are your actual chances of being audited? Is it just like winning some terrible lottery? Or is there a real method to the madness? Let's get into the real numbers.
Okay, first things first, we've got to bust a huge myth. A lot of people see an audit as just a random stroke of bad luck, kind of like getting struck by lightning. But expert analysis shows it's not a lottery at all, not even close.
So let's start with the big headline number, the overall audit rate. According to recent data, the agency only audited 0.266% of all individual returns. To put that in perspective, that's less than 3 audits for every 10,000 people who file. So on the surface, your odds look incredibly low.
But here's the twist, and this is absolutely crucial. While the overall chance is tiny, that risk is not spread out evenly among everybody. The whole selection process is actually a very calculated, data-driven system. It's not about luck, it's all about strategy.
And that brings us right to the agency's strategic playbook.
See, to understand your personal risk, you have to start thinking like they do. You have to understand the logic that decides who gets a closer look and, more importantly, why. And it all boils down to one core business principle.
Think about it. The tax agency has a limited budget and only so many agents. They can't look at everyone. So they have to use their resources where they'll get the biggest bang for their buck. This is what we call return on investment auditing. They focus on the returns where they're most likely to find big errors and get back the most money. And this comparison just makes it crystal clear. Finding a mistake on a $50,000 return might bring in a few $100s. But that same type of mistake on a $1 million plus return, that could mean recovering tens, maybe even hundreds of thousands of dollars. From their perspective, it's just smart resource allocation.
Okay, so we know they're playing the ROI game. The next logical question is, does that make you a prime target? Let's break down the profiles of who is statistically most at risk. What the data shows is really fascinating. It creates this very distinct U-shaped curve. So on one end, you have low-income filers who claim credits like the Earned Income Tax Credit. They actually face a higher than average audit rate. Then the risk plummets for middle-income folks. But on the other end, it shoots way up for high earners, hitting almost 3% for people making over $10 million. And listen, it's not just about how much you make, it's also about how you make it. If you're self-employed, a freelancer, a sole proprietor, running your own business, you're probably filing a Schedule C. And that form, it's basically a magnet for extra attention. It's just more complex and has tons of deductions, which means way more opportunities for mistakes or for people to fudge the numbers. So this brings us to the actual red flags. These are the specific things on a tax return that can make an automated computer system or a real human agent stop in their tracks and say, let's take a closer look at this one. So what kind of stuff are we talking about? Well, think about anything that just seems out of the ordinary. Reporting huge business losses, especially if you do it year after year, that's a big one. Claiming deductions that seem way too high for your income level is another trigger. And if your business deals with a lot of cash, like a restaurant or a salon, you're automatically going to get more scrutiny. But if you want to know the number one, almost guaranteed way to get a notice from the tax agency, it's a data mismatch. Here's how simple it is. Your brokerage tells the agency you made $100,000 in gains, but you only report $50,000 on your tax return. Their computers are designed to cross-reference that stuff automatically. The second they see that discrepancy, bam, it's an instant red flag. Okay, so we've covered the risks, the red flags, all the stuff to be aware of. Now let's pivot. Let's talk about defense. How do you build a tax return that's so solid, so defensible, that you don't even have to worry about this stuff? Your defense plan is actually pretty straightforward. It starts with the basics. Report every single dollar of income you make, no exceptions. Next, for every single deduction you claim, have the documents to back it up, receipts, logs, everything. Third, use good software or a qualified pro to minimize simple mistakes. Fourth, be realistic. Don't claim crazy deductions that make no sense for your business. And finally, just try to stay educated because these rules can and do change. So when you boil it all down, what's the big takeaway? Your best defense isn't about hoping you don't get picked. It's about building a return that is so clean, so well documented, and so accurate that it can stand up to any scrutiny that comes its way. It's about being prepared, not paranoid. And all of this leaves us with one final and maybe the most important question to ask yourself. When you're filing your taxes, is your strategy built on just crossing your fingers and hoping for the best? Or is it built from the ground up to be defended? Because the answer to that question, that's what truly determines your real risk.